Hello guys, it's Mike Rumaka here, and in this video we are going to be talking about the basics of indices trading. Here on the channel we talk a lot about how to invest in the stock market, but today we are going to be taking investing in the stock market a little bit further by getting into indices trading. This video is going to be one out of a series of videos I'll be making on this channel on indices trading. In this particular video, we are going to touch on stocks and try to relate them to indices trading. We will explore the background and development of index trading and the different markets in which you can trade their indices. We will also cover the benefits and risk involved with trading indices, and by the end of this video you should have a solid background knowledge of index trading. Do well to smash the like button and subscribe to the YouTube channel, and without much talk, let's jump right into today's video. Let's go. Before we dive headfirst into the world of indices trading, let's start with the basics of stocks. Think of stocks as your slice of ownership in a company. When you own a stock, you are essentially a shareholder holding a piece of the company's pie. Now, why do companies even have stocks? Well, they sell these slices of ownership to raise money. Then in return, shareholders, that's potentially you, get a piece of the company's profits and sometimes even a say in important decisions of the company, oftentimes through voting. Understanding stocks is crucial for navigating the world of indices trading, because indices tracks the performance of a basket of stocks and not just individual companies. You see, when you buy stocks, you are taking your chance on a single company, but index trading offers you the opportunity for diversification, spreading your risk across multiple sectors and industries. It's like buying a carton of drink that has different brands like Coca-Cola, Pepsi, Malt, instead of buying a carton of drink that just has Coca-Cola drink in it. While analyzing individual stocks can be complex, indices present a simpler picture. They offer a broad view of market trends, making it easier for you to track the overall performance and make informed decisions without needing to research on numerous individual companies. For example, if you wanted to invest in the Nigerian stock market and you wanted to know how the overall stock market is performing, if you should get into the market or not, you will likely want to take a look at the NGX All Share, which is an indicator that helps you to gauge the market and track price movement over time. Notwithstanding, it's important you know that understanding stocks unlocks the door to index trading, where you can potentially benefit from broader market growth, reduce risk, and even leveraged gains. Alright, so now that you have gotten a grip on how stocks open the door to the exciting world of index trading, let's take a step back and look at the background of index trading. You see, the concept of index trading didn't just pop up overnight. It has a rich history that dates back to the late 19th century as industrialization and economic growth swept through the United States of America. Some men going by the name Charles Dow and Edward Jones created the Dow Jones Industrial Average (DJIA) in 1896. The DJIA started by tracking just 12 companies, offering investors a way to weigh the performance of key industrial sectors. Now, after World War II, indices trading began to expand globally. The S&P 500, launched in 1957, captured the performance of 500 leading companies in the United States, reflecting a broader market sentiment. The FTSE 100, which tracks the performance of the 100 largest UK companies, and the Nikkei 225 in Japan, followed suit, symbolizing the globalization of indices. Actually, the advancement of technology and the dot-com bubble helped to fast-track the growth of indices trading. Now, as we took a brief journey through the history of indices trading, we talked about its global expansion after World War II, with iconic indices like the S&P 500, the FTSE 100, and the Nikkei 225, which captured the essence of the US, the UK, and the Japanese market respectively. It's now important we take a look at the different markets where you can trade indices. You see, indices fall into two major categories. One is the benchmark indices, often dubbed the creme de la creme. These indices comprises of top performing companies, serving as a reference point for the overall market. They represent a broad variety of stock, providing a standard for performance comparison. Examples of benchmark indices include the S&P 500, the Nifty 50 and DAX 50. It is worth knowing that benchmark indices can also zone in on specific geographical regions, showcasing the cream of the crop in those areas. Then we have the sectoral indices. These indices focus on specific industries or sectors, offering a detailed view of performance within those segments of the market. Example includes the Nasdaq, which tracks the performance of the technology sector in the United States. Then you also have the S&P BSE, which tracks a wider range of sectors in the Indian stock market, including financials, the energy, industrial, technology, healthcare, and consumer goods companies. Sectoral indices allows investors to tailor their portfolio to specific areas of interest, whether it be technology, finance, healthcare, or like whatever sector they want. If you are looking at trading in both of these markets, then you have to find a software that allows you to do so. An app I found is Vantage Market. It has over 1 million downloads on the Google Play Store. There are about 26 indices on the app, and it's a mix of both sectoral indices and benchmark indices. I will leave a link to download the app in the description and comment section. Now let's take a step back. I believe by now we have understood the basics of indices trading, but I still believe it is important we go through the benefits and risk involved with trading indices for you to be able to make an informed decision on whether it is something you want to venture into or not. So what are the risks? One of the risks involved in indices trading is market volatility. You see, fluctuations in stock prices, economic conditions, or geopolitical events can impact the performance of indices, leading to potential losses for investors. Another is liquidity risk. While popular indices like the S&P 500 are highly liquid, smaller or niche indices may not be as easy to buy and sell, meaning you might face difficulty in selling the indices at your desired price because many people are not interested in buying them. Finally, we have psychological risk. You see, the emotional ups and downs of trading can be challenging, leading to impulsive decisions based on fear or greed. So it's important to have a solid trading plan and risk management strategy in place to avoid emotional trading mistakes. Now, moving over to the benefit of indices trading. One thing you stand to gain is a broad diversification. Unlike focusing on individual stocks, indices, like I mentioned earlier, represent a basket of companies, thereby spreading your risk across different sectors and industries. This diversification then helps you to mitigate your exposure when individual stock performance, are performing badly. Another cool thing about index trading is that it offers a convenient way to gain exposure to entire market or specific sectors without needing to research and analyze numerous individual companies. This simplifies your investment process and saves you time compared to picking individual stocks. Overall, it is worth knowing that indices trading is almost similar to forex trading. The difference is that when trading indices, you are trading a basket of stocks, while forex trading, you are trading currencies. In the next video in this series, I will be comparing forex trading to indices trading and revealing which one I would choose if I was to go full time in any of them. Meanwhile, if you enjoyed this video, I have another one where I break down how to buy Facebook shares from Nigeria. Click on the end screen to go watch that video, and don't forget to smash the like button and subscribe to the YouTube channel. It's totally free of charge, and see you on the next one.
No one is born a trader. Be reborn a trader. Trade smarter at Vantage.